All right, let's get right into it. For decades, the story we've been told is that financial markets are basically random, right? A coin toss? But what if that wasn't true? What if there was a model, one grounded in actual science, that could predict market moves with just, well, stunning accuracy? The dream of beating the market is as old as the market itself. But as we're about to see, having a perfect map is one thing. Actually navigating the treacherous terrain of your own mind, that's a whole different battle.
This quote from Keynes, it pretty much nails what we're talking about today. The biggest challenge in figuring out the markets might not be how complex the data is, but how deeply we cling to our old beliefs about how it's all supposed to work. So let's start by challenging the biggest belief of them all.
For years, the random walk theory has been the dominant idea. It says that price changes are totally unpredictable, just like flipping a coin. But what if they aren't? What if there are actual underlying forces causing these moves, kind of like the physics that governs weather patterns? And this brings us to a really fascinating scientific challenge to that whole random idea. It's a framework that doesn't just look for statistical patterns, but actually tries to model the market as a dynamic system of cause and effect. So let's see how this thing actually works. Okay, so say hello to the Extended Samuelson Model, or ESM for short, and its core idea is a real game changer. Instead of just looking at the price, the ESM measures the real-time imbalance between the aggressive buyers and sellers, the liquidity takers, and the more passive ones, the liquidity providers. The model argues that this imbalance is the real engine driving the price. It's a total shift from just asking what happened to finally understanding why it happened. So the ESM breaks the market down in a really unique way. First, it treats the market not like a casino, but like a complex natural system. Then it calculates this key metric in real time called normalized excess demand, or NED. Now from this one number, it generates 6 distinct signals that tell you where the price is likely going. And it even categorizes the market's overall mood into one of 8 states, everything from total pessimism all the way to wild euphoria. This whole structured approach lets it predict major turning points and even huge market crises. So, how accurate is it? Well, in real-time forecasting tests using high-frequency 5-minute data, the model's predictions for price reversals were right 95% of the time. Let that sink in for a second. 95%. A number like that doesn't just suggest you can beat the market. It basically throws a wrench in the whole efficient market hypothesis that says you can't. This isn't just theory, it's a tested, high-accuracy tool. Now let's see it in the wild. This is a daily chart of the S&P 500 from early 2025. You've got the price in candlesticks, and that black line, that's the market state. Now, notice right there on February 28th, a signal 4 pops up. That's a signal for a reverse to a downtrend. And look what happens right after. The market state just plunges from a neutral position all the way down to state 1, its most pessimistic level, right as the price tanked. And this model is robust. On the left, you're looking at the S&P 500 during some of the most volatile days of the year. Huge price swings. The ESM is still in there, identifying the shifts between states and signaling the direction. But honestly, the chart on the right is even more impressive. These were the calmest days of the year, where the price action looks like pure random noise to you and me. But even in there, the model is picking up on these subtle shifts in pressure between buyers and sellers and forecasting these small but still profitable swings. So, we have a model that seems to have cracked the code. The market isn't random, it's predictable. Problem solved, everyone gets rich, right? Well, not so fast. This is where our story takes a sharp and very, very human turn, because knowing what's going to happen is completely different from actually being able to do something about it. And this is the question that just hangs over everything, isn't it? If you have a tool that's 95% accurate, the path to wealth should be pretty straightforward. But it's not. And that's because the biggest, most unpredictable variable in the whole trading equation isn't the market. It's the person staring at the screen. The machine might be nearly perfect, but the operator? Well, we're human. And here they are, the culprits. These cognitive biases are hardwired into our brains. Confirmation bias makes you ignore the model's sell signal because you feel like the market should go up. Loss aversion, that's what makes you hold on to a losing trade way too long, just hoping it'll turn around, because the pain of actually admitting you lost is just too much to take. These little mental glitches are constantly working to sabotage even the most brilliant strategies.
This quote just captures the danger perfectly. After you take a couple of losses, logic goes right out the window. The plan is totally forgotten. All that matters is getting your money back. We call this revenge trading, and it is a psychological death spiral that has blown up countless trading accounts no matter how good the strategy was to begin with. You go from disciplined execution to pure destructive impulse.
So the takeaway here is crystal clear. You can have the most advanced predictive model in the world, but if you haven't mastered your own psychology, your fear, your greed, your biases, you are going to fail. The market is just an arena. The real opponent is the reflection in your screen.
Okay, so let's step back from the models and the mind games for just a second and talk about the cold, hard logistics. What does it actually take to even step into this arena as a full-time pro? Because the practical barriers you'll find are just as tough as the psychological ones. You can just forget all those get-rich-quick ads you see online. According to financial experts, a realistic starting point to even think about trading full-time is around $200,000. And that's not just trading money. That number has to cover the legal minimums for day trading, plus enough cash to live on for at least a year, because you can't trade effectively when you're stressed about paying your rent.
And that capital, that's just the entry fee. The pros have a checklist, and believe me, it is non-negotiable. You need a documented track record of at least 2 years of consistent profits, and not just in a raging bull market. You need a huge cash cushion set aside, a formal written business plan, and a solution for stuff like healthcare. You have to treat this like the serious business it is.
And let's talk about your competition for a minute. You're not just trading against other people like you. You are up against high-frequency trading firms. These places operate at speeds measured in millionths of a second. They have their own secret algorithms and direct fiber optic lines to the exchange. As one analyst put it, a retail trader competing with an HFT firm is like bringing a bicycle to a Formula One race. You're outgunned before you even start. And finally, there's the stuff nobody ever talks about, the complex, unglamorous, but critical details. Take taxes. If you trade certain futures contracts, your gains can get special treatment under something called Section 1256. It's a huge advantage, but you have to know it even exists. See, mastering the market means mastering all of it, the psychology, the risk, the strategy, and yes, even the incredibly boring tax code. And that brings us right back to our central theme. A tool like the extended Samuelson model suggests the market might actually be knowable, maybe even predictable. But the ultimate question isn't whether you can understand the market, it's whether you can understand and control yourself. Because in the end, that's the only prediction that truly matters.